Alright boys, hope everyone's well. Got ourselves an interesting open at the start of Europe here. Straight into it, what's causing the US dollar strength? A little bit of optimism now that the vote to repeal Obamacare is going to get passed. This is coming along mainly on the back of reports that John McCain is flying from hospital after he had brain surgery, brain cancer surgery, for a vote. Right now, why would you do that unless you're voting yes? And then you wouldn't do that unless you needed the numbers, and the numbers must be there to the point where he's going to pass it. Okay, pretty much that's the case. And so a little victory for Trump, and perhaps the agenda is back on the table. At this point, the market will take any victory, and the US dollar is reacting to that. So you're seeing that expressed mainly through dollar yen, risk on euro yen and pound yen. A little bit of pushback against the Aussie. Probably the the result here that the lows are getting lower, the highs are getting lower, and also the fact that tomorrow is such a big day. Profit taking might be just a little bit too strong for the Aussie yen buying at these levels. You got to respect the strength it's had though. I mean, easily could have pulled back a lot more than this. So I'm pretty neutral on the Aussie going forward here. Wouldn't surprise me at all if even if the CPI and the governor pushes it down, that comes straight back up. So I'll be watching around 98.60 as a buy zone, see how that goes, and then looking to buy into any constructive sort of strength tomorrow. Tomorrow's a big day in the Aussie. You got the FOMC coming up after that tomorrow as well. So you have multiple ways in which the US dollar can get strength, multiple ways in which the Aussie can get weakness. But I think the market is retail's too short, and the path of the resistance will be higher over the time. So, but we'll see. I'm very open to selling, very open to buying, just not at these levels, right? Selling at 80.50 on the right sort of reversal patterns, and buying at 78.60 is my way I'm looking at the moment. More favoring buying though, given the US dollar backdrop. I don't think any US dollar strength is going to be sustained, but very wary of the levels we're at on the dollar index. Is sort of the levels that you could get a multi-week reversal from. And so we're looking at the weekly here. You got that lows from last year in 2015 supporting right now. So it's going to take some pretty dovish Fed to get the market to sell dollars more initially. Perhaps if the rally fails though, so euro goes back towards 115, dollar yen back towards 112, 112.50, and then pauses, and then sellers come back in for whatever reason, then next attempt down could be the really big one. But right now I think the timing and the sort of the length of the run deserves a pullback, and that's the pullback I'll be looking to buy euro dollar on, not really chasing here. I mean, anything can happen. You could have a really dovish Fed, but I wouldn't be banking on that right now, because the market's turned ultra dovish, right? So you really have to see a significant shift to meet the same level of dovishness that the market has. And the Fed has been pretty cautious both ways, not coming across too strong and not coming across too weak. So mildly hawkish, or not as dovish as the market was expecting, is probably what's going to happen tomorrow night. And but we'll talk more about that tomorrow. Yeah, that's not the main thing on today. The main thing we have to do is look at if the stocks continue to have a little relief rally. You can see DAX tempting here, stage of recovery. How much US dollar sort of profit taking there will be, it should be your main concern right now. If you're long euro, you're probably a little worried about this price action. If you're short dollar yen, you're definitely worried about this price action. So, but yeah, the Aussie dollar, it's been dangerous to sell, regardless of the reasons. But yeah, that's the update from yesterday to today. It's good to see some a little bit of positivity in the market. I really like to buy euro yen and like buying dollar yen. Let's have a look at those at the moment. Nice price action there. Yeah, this is looking nice. Dollar and the pound's pretty constructive too. It's a daily. Dip's pretty shallow. So we'll see how we play. Remember, the pound loves, you know, a pound yen rally to support it, and you probably see the euro pound under pressure today if that was to be the case, guys. It's not a bad trade actually. So a little bit of euro pound in this sort of market, this sort of effect is I mean, I'm not going for many pips, just back down towards 80.80. Just the reasoning for this trade is who's going to win in a euro yen pound yen battle, and it's probably going to be a pound yen. Pound consolidated above 130 as well, so it's probably going to be asking the question soon of the resistance here. In terms of data wise, tonight German IFO came in slightly stronger. Exports from Germany, prices slightly lower. Consumer confidence, I mean, the market does respond a little bit to that if it was focused on that. These levels are pretty high. I don't think they're going to really affect the market or the Fed expectations that too much. Tomorrow morning you have RBNZ Assistant Governor McDermott speaking. RBNZ is known to jawbone, so this is another worry for the Kiwi dollar in the next 12 hours or so. Kiwi dollar could come under selling pressure at the end of the US session tomorrow if he says the right things. I'm not sure what he can say to get the market really. He has to say more, repeating what was said, that, you know, New Zealand's strength is making the recovery a bit more challenging. You know, it has to be a bit stronger than that. But RBNZ's one of the current central banks around the world that has intervened in the currency in the last 5 years. Not too many have. I think it's intervened twice in the last 5 years. But really, we're looking for the main events tomorrow. The CPI from Australia, then the RBA governor. Really, at these levels, the Aussie has a bit more selling to be done if the jawboning is done right and the CPI misses. Now, the New Zealand CPI missed badly, yeah. So the Aussie CPI, you know, it's not a big stretch to expect that to miss as well. But the market's pretty aggressive on buying dips, and really the US dollar side of the equation's the bigger side of the story as to why the Aussies are up here. Not so much the central bank expectations. And if the euro is going to 120, I think we're going above 80 on the Aussie and above 75 on the pound. Sorry, on the euro. Sorry, on the Kiwi dollar. Yeah, got there finally. Eventually, yeah. So using dips as buying opportunities broadly in the next couple of weeks will be my game there. Here it is, Norse. You know it. You're on the ball, mate. I like it. Let's have a look at some data, some bank research here. Got a few banks coming out with their previews for the FOMC. Got the cheat sheet coming out from ING. Always pretty. Oh, they make some nice research actually. Simplified, to the point. Ooh, some nice movement here on the. You can buy DAX too. I bought DAX already. You can buy a little bit of DAX here in this market right now. Probably missed the entry though, but let's have a little look at it. Okay, let's buy a little bit of DAX. Buy a little bit of DAX. Alright, December high looking more likely than September. I think that's pretty much done for sure. Markets are particularly interested in the Fed's thought on recent sluggish inflation, which has caused a large divide between the Fed's rate hike projections, 4 hikes this year, And the market expectations, we've barely won. Sorry, by the end of 2018, where the market expects barely won. We expect the next rate hike won't come to December, whilst the Fed keeps an eye on the recent inflation developments. Okay, so that, I mean, that's really what the market's looking for as well. Yeah, so we have to see them walk back their language so the market gets the hint that's not coming in September. In terms of any sort of announcements, we're probably not going to get any announcements about balance sheet reduction, but you know, September is a very good time for that, and that's true. Yeah, a lot of analysts on the same page here that September is going to be the balance sheet reduction, and that's also a form of monetary tightening. And this is another way US dollar can have a recovery, guys. There's multiple ways here. There's actually, if you're looking at the bond traders and the guys trading the euro bonds, they're a little worried that the euro is getting ahead of the bond rally at the moment, because there hasn't been the timeline made for the ECB yet and the tapering. So it's very hard to see into the future and see what that timeline will be and when they're going to raise rates. Therefore, the bonds are getting a little cautious at these levels. So the euro rally can really slow down if you don't get a bit more certainty from ECB shortly. Alright, there's a risk that the Fed hints in this week's statement that the process could commence soon. An implicit signal ahead of the next meeting in September. Okay, so any language around it's probably going to be overanalyzed. I'm not a Fed watcher by any means. So in terms of a status quo Fed statement could be mildly supportive for a politically plagued dollar. Now imagine if he gets the vote passed tonight, Trump, that part could be a little bit lessened, and you know, along with the Fed tomorrow, could see that US dollar have a couple of days, you know, stop hunting on the reversal here. Yeah, so nothing crazy. Pound yen's enjoying this. Euro's not so much. So that trade we took, you know, about 10 minutes ago was on the short euro pound. Basically on this same reasoning, guys. Alright, so on the topic we were talking about earlier about the jawboning in the Aussie, let's see what Deutsche Bank has to say about that. Where's the pain point for the RBA? We know that the New Zealand RBNZ is already in this pain point. RBA commentary tended to describe AD as above fair value and needing to fall. The Aussies' return to those levels might suggest a return of the language. What are the key drivers need to be considered? Aussies drive little support from interest rates. Yeah, pretty true. Not too much priced in yet. But the iron ores had a 30% rally from lows. And you know, that's helped. Obviously Chinese data has been pretty strong too. Market's not focused on China. Alright, so just scope for RBA commentary to change. So yeah, year on year inflation still going to be below 2%, the target. They're maintaining a bearish view. Okay. A small decoupling here going on between the advantage we have in the yields over the US yields. Nothing crazy. This would change dramatically if the US 2 years started to price in more rate hikes as well, because we know that by the end of 2018 only one hike is fully priced in. Could easily rally more in terms of the yield rate differential. So this can come back down pretty quickly. Yeah, definitely tomorrow the risks are skewed towards him saying something similar to what his deputy said, so I really think that's what we have to be looking for. So I mean, it's expected to the point that what is important is the reaction, right? The reaction, if the Aussie is not below 79 by the time we have a chat tomorrow, there's a problem. Yeah, so tomorrow's update, if we're not below 79, it's very hard to be bearish on the Aussie guys. Looking for a weekly sell. It's 124. Jesus. Yeah, that would require some risk off. A dollar yen collapse, maybe some Japanese political turmoil, PM Abe leasing out. Yeah, that's definitely possible. Kiwi dollar, we've already talked about Aberam. Kiwi dollar is quite high, but we've already had jawboning and a weak CPI from New Zealand. So there's another speaker tomorrow morning that could try and talk it down again. But really, if you're selling the Kiwi, you want a Fed to come out gangbusters and push the market down. But broadly, even if that happens, go back to 73.50, you probably want to be looking to buy that sort of dip. Yeah. So it's easy enough to see the market pulling back to here, but you want to keep with the trend generally. A little worried that you're not going to get that follow through that you're looking for. That sharp selling that you can get on the Kiwi sometimes, it just hasn't been around for a while. Alright. 1 second, boys. Ooh. A little UBS video here. This is probably a little too advanced for the room, but interesting topics. Yeah. All these unconventional tools and how that affects things. Let's have a little watch of the video.
Hello, my name's Mark McDonald, and I'd like to highlight a piece we've just published called FX and the Yield Curve. In the FX market, we understand the process of a normal tightening cycle very well. Hikes in policy rates lead to higher short-term interest rates, and this has typically been positive for a currency. However, we appear to be entering a world of unconventional tightening. These unconventional measures may be used as a substitute for rate hikes. So what will this mean for the FX market? These unconventional measures are as likely to change the shape of the yield curve as much as they are to change the overall level of rates. So to answer this question, we need to investigate how changes in both the level and the slope of the yield curve influence exchange rates. We've crunched the numbers, and we find the following broad rules of thumb. The first result, which should surprise nobody, is that higher rates are associated with a stronger currency. The second result is that once you've taken into account the change in the level of rates, a steepening curve is associated with a weaker currency. And finally, if both the level and the slope of the curve changes, then it's the change in the level which is most important. So what does this mean? It means that if the level of rates goes up and the curve steepens, this is less positive for a currency than if the level of rates goes up and the curve flattens. As well as these broad rules of thumb, we find two more notable results. First, it's not just about interest rate differentials. In FX, it's common to model exchange rates against the difference in short-term interest rates. However, we find that this approach can miss important information and suggests that it's better to include the interest rates from both currencies as separate variables than it is to simply consider the difference between them. Finally, the sensitivity of FX to rates changes over time. This means model parameters must be updated frequently to prevent them becoming stale. These are the main takeaways from our analysis.
Jeez, I'd like to have a drink with this guy. He sounds like a barrel of fun. An absolute barrel of fun.
Hi, I'm Dominic Bunning and I'm here to talk to you about a new report we've published as to why we think the euro remains in pole position. The euro's already experienced quite a significant rally this year, and it's led some people to question whether actually the market's got a bit irrationally exuberant on the currency, and potentially whether positioning has got too stretched and therefore a pullback is likely. We look at 6 different indicators for various types of market positioning, and actually find that, generally speaking, the market is not aggressively long the euro. Yes, some of the shorter term investors, when we look at the IMM data and even in some of the options market data, do suggest that the short term investors are starting to get long euros. But when we push out the investment time horizon and think more about portfolio flows and reserve managers,
1 sec, mate.
it seems that a lot of these investors look
Not a
very
big
much
trade, just
underweight
small
the euro still.
Given
that we believe the cyclical, political and structural backdrop is improving for the euro, we think that these types of investors could actually provide further impetus to the euro rally in the coming months. And that's why we have a forecast which is much more bullish than the consensus for euro dollar, which is to move to 120 by the end of the year.
Jesus Christ.
Thank you very much.
I actually want to hear that next bit. Why a rate rise would be negative for the pound. So we'll look at that in a sec. I just want to answer John's question here. We're on the short euro pound trade. What sort of take profit? Probably just below. Probably around 89.10. Yeah. So take out those lows, but nothing really crazy to drive this. This is just a little bit of pound yen's going to go berserk as the market revalues dollar yen. Euro yen might get left behind a little bit, and so it's just a little play against that. It's a relatively safe sort of trade without too much data being released right now. Okay, so it's not a huge trade, just a small short pressuring trade, and the risk is pretty tight here. We're talking about a 15-point stop, so just a little intraday sort of scalp makes sense to me. Just quickly want to check what's going on in the euro. So the DAX though. What is going on in the DAX? Getting in trouble here. Don't you reverse? Okay. Okay. Not. It's having a think, isn't it? The old DAX about what to do here. I suspect we're going higher. Just so I have to keep an eye on it later. Probably need a little bit more confirmation here from the, the Dow getting to 20 is nothing. But the target on the DAX is probably 24. DAX had a huge sell-off, remember, that's half the reason we're looking at it. See what happens up here too though. Yeah, probably around 24. That's not a big rally for the DAX after the selling it's had. 800-point drop. Little pop here on some good news. Everyone's just got to get the memo. Not everyone's got the memo this morning. If it gets back below 1250, I'd be concerned. Yeah, so where were we? Watching a couple of HSBC videos, as you do. Just one more. Just want to... Just one more. I love this guy here. This guy here is my favorite analyst.
Hi, my name's David Bloom and I'm Head of Currency Strategy at HSBC. I'd like to talk to you about our latest currency outlook, where we have 3 feature pieces, all of which are non-consensual.
Remember when we listened to this guy talk about the pound who killed it? The interview that we watched. No doubt he's still bearish. Let's see if he's still bearish.
The first one is sterling and why we expect it to go to 120 by the end of the year. And then we'll have Dominic Bunning talking about why we expect the euro to rise towards 120, and as well as why we still think dollar yen will head downwards towards 100. But first of all, let's talk about sterling. The big theme that's currently running through the market is the idea that the Bank of England can raise rates. We don't really believe this. Nevertheless, it's worth examining what would actually happen to the currency should they raise rates. Now, the knee-jerk reaction and the way we're mostly taught in FX market is rate rises are good for a currency. And that to the main is correct. However, that's when a currency is behaving in a purely cyclical manner. We would argue that in the world of cyclical, structural and political, that sterling is a structural and political currency. Obviously the politics emanate from Brexit and what's going on in Downing Street, and of course the current account deficit is the main structural issue. And so we would argue to raise rates is naive. It's naive because you think that this is a cyclical world we're living in the UK. And if it were a purely cyclical world, of course we would argue an interest rate rise is good for sterling. But it's these other 2 factors that we think dominate, and we think it would be a mistake to raise rates, and the market would soon recognize this and recognize that the structural and political concerns are far greater than any cyclical inflation worries. And for that reason, we still think sterling will go down to 120, whether the Bank of England and the MPC raise rates or not. I'll now hand over to Dominic Bunning to explain why we think the euro is going up and the yen is going to appreciate as well.
Thank you, David. We've got much stronger than consensus views on both the euro and the yen. And in this report, we explain why. Starting with the euro, we look predominantly at cyclical factors in this piece. And we talk about why a potential move higher in German bond yields could be very supportive for the euro. We've already seen a fading of political risk in Europe, and therefore we think cyclical factors could become even more important for the euro through the rest of the year. Our rates team have got a counter-consensus view that bond yields will head a lot higher from here, in such a way that we've only seen 4 times since the crisis. Those periods have also coincided historically with much stronger euro. And therefore we think this time around we should see a similar move. We have euro dollar going to 120, where the consensus is only around 112. Similarly for the yen, we see the currency strengthening from here and dollar yen falling to 100, while the consensus view is that it stays around spot. We've seen a significant weakening in the yen, not just in the last few years, but even in the last few weeks. In our view, a lot of this is a mispricing of the economic reality in Japan. There are still seemingly hopes that Abenomics will deliver some kind of meaningful reflation, and that therefore the yen can actually start to weaken.
This is a pretty interesting argument, guys, about why the dollar yen's going to fall.
But when we look at things cyclically in terms of a rebound in inflation, structurally in terms of the lack of wage growth, or politically in terms of the will for further reform, it seems unlikely that this will be delivered. Therefore, we think the yen will have to give back a lot of the losses we've seen in recent years. Fair value for dollar yen in our view is somewhere around the 100 mark, and therefore that's where we see dollar yen going through the rest of the year. Thank you.
Alright. Yeah, send the link in. Maybe you can. I don't know if it will work for you guys. Just a little rant videos. Not bad, not bad. Interesting. Bit out there on the dollar yen anyway. But yeah, we'll see. Tomorrow, guys, just let's be cautious about that CPI number. Remember, the New Zealand mix missed by 0.2%, and the RBA is likely to come down and talk. So expect the market to have a go lower, and if it doesn't hold though, and it starts to buy after that jaw boning, that's where we know that the Aussie's got that underlying strength that will scare the bulls, sorry, the bears, because the bears are all banking on this, right? Everyone's selling on the same reason, that the RBA is going to jawbone it. And if it doesn't work out like that, you've got that squeeze above above 80 cents coming sooner rather than later, maybe even during the Asian session. If one of those two things don't happen, like a decent CPI number, or he talks up chances of a rate hike by not talking them down, right? The RBA governor. Then you'll see probably 80 cents go, and that becomes much harder to sell into. We talked about selling into a break above 80 on Monday. That was before Wednesday. Yeah, we don't want to be short after Wednesday above 80. Yeah, the market's on its next leg, and it could go to 83 without pause. So don't want to get caught up in that. But yeah, we'll see what happens tomorrow. Will definitely be an interesting stream tomorrow at 7 o'clock. And in that stream, after looking at the Aussies' reaction and even the Kiwis' reaction to the central bank speakers tomorrow, we will go into a bit more of an in-depth preview for the FOMC. The FOMC meeting, keep in mind, is not one where there's a press conference, just a placeholder meeting. Alright guys, good luck with your trades. Keep an eye on this risk-on little rally that we're getting on the back of the Obama repeal vote seemingly going to get passed. Let's see how US plays it. Definitely a bit of front running here going on dollar yen in anticipation, so we'll see.